Well, if you look at the backdrop, the Dow in the US is only 6% from all-time highs. The S&P in the US is close to where it was in May. You've had some pretty horrible numbers out of inflation numbers out of the UK this morning, which you've alluded to. There's a lovely old adage in the press, isn't it? If it's in the press, it's in the price. I've just checked futures on for the financial futures for interest rates for June of next year. They're only looking for a 20% probability of a hike to 4.5%. So they're not pricing in huge interest rate actually sort of increases from here. And you've got to remember, Jeff, you've had some, you had some pretty nasty unemployment data yesterday. The ONS talked about unemployment rising from, what was it, 3.5 to 3.9% in August. House prices are rolling over. Mortgages applications are falling here in the UK, and commodity prices, et cetera, are falling. So you're seeing what we saw in the States. So you're beginning to see a lag of the inflation data. And that's why markets were so strong in the US. Look, the UK is on 9 times. It's on a 4% yield. And there's a lot of doom and gloom around. And I suspect the markets are in a bottoming process. So we've been advising clients, to your question, of rotating back into some of the equity markets, given the recent strength and the backdrop.
It's the conundrum, isn't it? Because what you've described is a tale of woe around the economic indicators, and yet the markets are managing to push higher from here. And I guess some of it you could pin on valuation, which I think you are doing here. But it's not only been the UK. We've seen the DAX 20% off its lows. The French market's up about 17, 18% off its lows here. So we are seeing a broad re-embracing of European equities. Is this American money that's starting to cross the channel to find a better value alternative, or is there another reason for people hanging on here in spite of some of the weakening economic data?
Well, another good question, Jeff. I looked at the ETF trade flows in the US last week, and you've had some of the best moves ever in the US and the NASDAQ last week. And nearly 20 billion of money went into US ETFs last week. So they certainly weren't switching out of US equities. They were putting more money in, the same amounts of money that they put in post-COVID, post the vaccine, post the financial crisis. So huge amounts of money are going back into equities. And generally, there's so much doom and gloom over here in Europe. Everybody talks about the UK and the Brexit problems, but everybody's got the same problems. Everybody's got inflation problems, labor problems. But the underlying environment is, which to your point is that stocks will always bottom before markets. And to your point, that the DAX is up 20% from the low. I looked yesterday, the semiconductor market, which is always a benchmark for activity in the US. That's up now above its 200-day moving average, and it's actually reversed its bear market. So there's a lot of movements actually in underlying stocks. So I think, Jeff, it's just a genuine interest. Europe is good value. China might basically, their zero COVID policy is being relaxed. So that's good news for Germany. So there's good fundamental reasons why money is coming into these individual stocks and markets.
Hi, I'm Joanna Bersecci, and thank you for watching. You can check out more of our videos by clicking on the boxes on the screen. And don't forget to subscribe to our channel for more from CNBC International. Thank you for watching.